Hey guys and gals, Kevin Bupp here. I've got some very exciting news I'd like to share with you before we jump into today's show. Now, after closing on Fund 4's first acquisition of a $50 million institutional grade mobile home park, we're adding a second irreplaceable piece of real estate to the portfolio, and it's coming into the fund with over $1.5 million of built-in equity for our investors day one. Now, when I say irreplaceable, I really do mean it. I mean, this is an affordable yet high-end waterfront mobile home park located in the Columbus, Ohio market. Quite literally, every single mobile home on this property is right on the lake, each with its very own personal boat dock, meaning a very high demand for affordable weekend getaway options, as well as year-round housing for working Americans. This is a true unicorn of a property, and you will not see another one like this come around again. It really is a one of a kind. A few other aspects worth noting. This park is producing stable and predictable cash flow day one. We're acquiring it with an excellent in-place Freddie Mac loan at a 3.3% interest rate for the next 8.5 years. This also includes a period of interest-only payments. Again, the simple supply and demand dynamics here are enough to get excited about. This is affordable lakefront real estate for both the working American families as well as folks looking to lock down a reasonably priced waterfront escape. Don't let this opportunity pass you by. Visit investwithsunrise.com to register for our webinar and learn about all the wonderful aspects of this property going into Fund 4. Again, that's investwithsunrise.com. Now, let's get on to the show. Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate investment expert Darin Davis. Now, Darin is an industry leader, a real estate entrepreneur, and founder of Club Capital, and brings over 2 decades of industry leadership and more than $1 billion of sponsored real estate projects. Now, he excels in navigating market shifts and guiding investors to exceptional returns, even in times of uncertainty like we're facing today. Now, aside from his real estate endeavors and in partnership with his 2 children, he launched the Never Quit Initiative, which is a 501c3 nonprofit organization. And the Never Quit Initiative, or the Never Quit Initiative's mission is to broadly educate young adults on the power of passive cash flow for income and prepare financially for a potential crisis in healthcare costs. And so with that, guys, I'd like to welcome Darin Davis to the show. How you doing, my friend?
How you doing, Kevin? Thank you so much for having me.
Yeah, no, I'm excited to have you here. Excited to peel back the curtain and get to understand and learn a little bit more about you and your business and what it is you do. But, before we dive into it, I gave you, that brief introduction there. I know there's probably a lot more to it than that. So maybe take a few minutes there. And for those that aren't familiar with you and who you are and what you do, maybe tell us a little more about yourself.
Yeah, no, thanks. I'll make it quick because it can get really boring really fast. But probably like most people, after I graduated college, I kind of took a traditional sales and marketing because I came out of the business school. Did that for the better part of 15, 16 years. Ended up in San Francisco doing software sales. And at that time, if you guys, any of your audience is old enough to remember this, but back in the late 90s, the internet craze and the .com craze was going. I mean, and it was the wild, wild west out there in California. But people were making money, but they were literally working, 90 hours a week. And I finally got to a point where I just said, you know what, I love the money and I love everything I'm doing, but I don't have control of my life. And literally, I didn't know what I was going to do next, but I knew I had to do something different. And my wife and I at the time, we decided, you know what, we're going to go into real estate. And back then we didn't have the internet. We had books on tape. And you had to go to seminars on Saturday morning.
I remember that time.
Do you? Okay.
Yeah. I'm aging myself, but I do. I still have stacks of those old, cassette tape binder things, right?
I know. I just cleaned out a storage unit about 6 months ago, and I'm looking at this and I'm going, is this worth anything? But I threw it all away.
You don't want to throw it away because there was so much value there, right? But you're like, what the hell do I do with these cassette tapes, right?
Yeah. So we just, we looked at real estate and we started small. And I didn't even know what the word syndication meant. I thought I was joining the mafia or something, I was like, what does this mean? But did a few deals and then got some friends and family. And the next thing I know, we have 40, 50 investors and we're doing larger strip centers and we're doing some land development. And then in 2008, we did our very first multifamily and it just started from there. And that's just about what we do. And it's probably the best decision I ever made, quite frankly. and it's good that I didn't know what I was doing, because if I had overthought it or gotten the analysis paralysis, and had more information, I probably would have panicked and done nothing. But it's been 24 years later, it's been one of the absolute best thing I could have done for me and my family.
Okay, no, I appreciate that background. So just curious, 2008, you did your first multifamily project, a somewhat unique time in history. And so was it, pre, financial crisis or post
Oh
financial crisis? I mean, I
no.
pretty much, yeah, I mean, like that crisis kind of carried on, through 2008 and beyond. But just curious as to how you navigated that volatile time.
Well, first of all, the crosshairs were right there. Okay. I mean, I think, and I got asked this question one time. We went like, well, how did you underwrite it? And I said, well, let me tell you what happened. We had secured a tract of land. This is, how I navigated a deal in 2008. And we had a takeout letter from a large lender. Well, 2007, 8 was happening. They just called up and said, game over. We're filing for bankruptcy. We're out of here. And I kind of looked around and go like, what do we do next? And so we just got really, really resourceful. We had to. I mean, we couldn't just sit still. We had our own money in it. We had investors' money in it. And I just started working with some friends and talking about navigating it. I got very, very resourceful. I learned what HUD insured financing was. I learned how to work with our city through some bond money. I learned how to do affordable housing. I learned a lot, and it was not, and I don't think I would have been near successful later on if we hadn't have just stuck the fire hose right up in our mouth and just said go. So I got this guy. He said, "Well, tell me about your underwriting for that." I'm gonna say, "Does anybody ever put a gun to your head?" That was our underwriting. We were going like, we don't have a choice. So it doesn't matter what the numbers say. We're going to lose money, and we said we can't lose money. So we just pivoted, and that's what we went and did, and it turned out to be the really truly to this day one of the best investments we made, because if you think 2008, I mean, construction had stopped. Okay. I mean, and Austin was not, privy to anything different than the rest of the country.
Hmm.
But Texas and Austin was still getting net migration and job growth. So when nothing got built for 2 years, and then we're the only thing coming out of the ground, I mean, the hockey stick effect happened for us. Leasing, rents, everything. So we just it launched that property, and that property we held for 14 years before we finally sold it.
Wow.
Yeah,
Wow.
it was
Fantastic. So
it
were
was,
you,
it was cash flow. It was great cash flow. Great, great, great cash flow. So
no, that's fantastic. So were you actually able to get a HUD financing on that property? Is that the
we
route that you went?
were,
Okay.
yeah. And I'll
That's a
tell you
very
why.
challenging program. And I don't
Oh,
know exactly, how the nuances were different back then with, all the craziness that was going on. But what just curious as to like that's not normally the first path. Like
oh,
normally you talk to multifamily guys been doing it for a long time and they've considered HUD, but like just there's a lot of additional challenges associated with getting a HUD loan than that of maybe your typical Fannie Freddie or a construction to perm, right? And so
very
just
true.
curious as to, what that looked like. And is that a staple of your business today, or was that something that you guys kind of sharpened your sword on and said, hey, there's something here. We should be looking at doing this over and over and over again and replicating that process.
Yeah, well, you kind of hit it. There's, HUD was most of the time is not in favor, because most developers or merchant builders, they build it,
Yeah.
they lease it, they sell it. And the HUD program is designed to, stabilize it and hold it for a period of time. But back then, we didn't have an option. Nobody was lending. So HUD was, the golden child, and they were the only one, and nobody would lend unless HUD would insure the loan. So we went through that process. And for the sheer fact that the city of Austin and I partnered together on some public private and some affordable rents and some tax exemptions that we got on it. HUD loves that, because anytime you can get involved with the city and get, deeper discounts on affordable housing. So they stepped up quickly and said, we love this deal. Now, had no HUD experience, and it is hard. So HUD said to me, well, you need a GC that's HUD approved, and you need a developer that's HUD approved, because you've never done a HUD deal. So when I talked earlier about getting resourceful, I had to go find those people that HUD would say, okay, we accept them as a GC, we accept them as a developer. And if you've got that team pulled together, then we'll approve your project. So, but yeah, We haven't typically done HUD because of a lot of the things you were mentioning. It is a longer process. There is some restrictions, and depending on what your capital wants out of the deal and what your equity is looking for, they're typically not looking to be in a deal 10 years plus. And some of the HUD deals are kind of structured that way.
Yeah, and some of them have what as high as 40-year amortization, or it's 35
Yeah,
typically the
yeah.
highest.
No, so the new and this is what makes some of the HUD deals affordable. The leverage is still pretty good, but the amortization on a new construction is 40 years. So it improves that cash flow. And there are HUD programs that are acquisitions at 35 years. So it still improves the
On
cash
the
flow.
acquisition side, my understanding, again, I'm by no means a HUD expert. I've never done one of the loans, but from the little understanding that I have in my P brain is that the biggest challenge of why they're not more common on the acquisition side is the time frame that it takes to actually get one done. Correct? It
That
takes
is
multiple times longer than your standard
yeah.
Fannie or
You
Freddie
you
loan.
you would have to put it in the queue with HUD, and it could take. I mean, on a good day, it may be 5 months. Normal. On a bad day, it could be 9. And you're not going to typically have a seller that's going to let you tie a property up for 6 months, 9 months, and
Yeah.
so you've got to have buyer seller cooperation. And you're right. You're exactly right. That's the
Which
knock on the acquisition.
Yeah, which hasn't really existed in the last 10 years.
Yeah.
Buyer seller cooperation, right? It's kind of like
Yeah.
who can pay the highest and get it done the fastest. Which
Period.
you're
Period. Non-refundable money
non
day
and
one. Yeah.
non-refundable money day one. Yeah, God, those times. I don't know if those the non-refundable day one is that a thing still today in the
No, we
multifamily
haven't
world?
seen that in about 4 or 5 years. But I mean, there was such a feeding frenzy here in Austin for about 6 years. There it was not uncommon to literally have groups put up $500,000 hard day one. Because you would get 20, 30 qualified buyers. When it wasn't uncommon to see a 3.5, 3.25 cap transaction
Right.
either. So
God, that turns my stomach to think of that.
yeah,
The non-refundable big chunks like that,
yeah,
non-refundable day
yeah,
one. There's just so many so many scales, especially when you talk about something that's 20, 30 years, 40 years vintage, right? Just so many unknowns there. And it's just very difficult to actually uncover all those. Even if a lot of some of the third parties maybe were done ahead of time, there's some inspection reports and things like that. Even then, just incredibly challenging to know what the heck you're really getting into. So
yeah. Not today though.
yeah, not today, not today. Well, I thought it'd be fun. I thought it'd be fun, a fun way today to maybe get a better understanding of kind of where you're at in your business, what you guys are focusing on to maybe take the multifamily space and let's do a an active SWOT analysis on it, at least from your
Yeah,
perspective as to and so again, better understanding of where you see the strengths, the weaknesses, some opportunities, and maybe even threats in the multifamily sector, and as it relates to your business. And so, I guess from a strength, and maybe I'll share my perspective as well. And I can only speak to it not necessarily from the we're not multifamily sponsors. I've got a good bit of personal capital with a number of different multifamily sponsors. So I understand the space quite well, but it's not, we're not lead sponsors. We don't run deals. We're in the manufactured housing space and the parking sector. And so, but I would love to, may I get my perspective and you kind of, you can piggyback on it and give me
yeah,
kind of what
sure.
your intel tells you and let's have some fun with this. So, as far as like strengths, at least again from my perspective, I would say that and we're speaking to multifamily, would be probably less competition, right? At this point in time, there's a lot of folks that maybe their liquidity dried up, maybe they're dealing with other problems within their business, right? It's more like damage control, and so like you just don't have as much competition for any of the deals that do come to market, and so that could be a strength. The fundamentals are still very strong in the majority of markets across the country, right? Like I think it's a hard point to argue, right? There's still a huge demand for affordable housing. It's here, it's present, it's not going anywhere anytime soon. And so like in my opinion, like those are two big strengths that immediately come to mind, but would love to hear your thoughts and opinions on that.
Yeah, I'll tell you from a macro perspective, nationally, you've heard 4, 5, 6 million homes are still needed. Okay.
Mm-hmm.
So housing is still in high demand. And then if you look where you live and I live, Florida and Texas,
Yeah.
we lead the nation in net migration. We lead the nation in job creation. So we're very fortunate that we're in these local markets. So drilling down into my state, just looking at the companies that are relocating here and the growth that we're having, multifamily, the fundamentals are still really good, but man, we are not without challenges at all. I mean, we have them right now. And in my business, we are primarily an equity provider for new construction. Sometimes we'll co-GP, sometimes, we'll partner in JV and do some stuff, but for the most part, we're the equity provider. And, about a year and a half ago, as we all know, we just started seeing, the negative leverage came in, the valuation started coming down. So it doesn't pencil right now to do new construction. Now we need housing, okay, long term. But Austin, specifically where I am, we have in North Austin, we overbuilt. Okay. South Austin, we really haven't overbuilt. So we're seeing some negative rents. I mean, some very flat rents up in the north, but in the south, we're still seeing 2% rent growth. So but we are oversupplied in general. It's going to take about a year and a half, 2 years. So if you look at our business model, we were going, all right, the guys were not going to be raising what we call common equity for any developers because our, permitting and construction starts are down 70% here in Austin, year over year, which is significant, even though it was pretty high. So, but what do? Well, being an equity shop, we work with developers. So the phone call started coming to us about a year ago saying, hey, do you guys do pref equity? And we know what it is. And we said, well, we don't currently have that platform, but we're working on building that platform. And for the audience that may not know kind of what pref equity is, I'll give you just a real high level definition.
Yeah, I was going to suggest maybe give us what that capital stack looks like and where
exactly.
pref equity plays into it.
Pretty simple. We've all if you've been an investor in the last 12 years, you had senior debt, which your loan for either construction or acquisition, and you had common equity. That was it. It was 1 and 2. What's happened because of the valuations and because of the low leverage and high interest rates, those numbers aren't working anymore. Well, the guys that have construction loans that are maybe year 2 or 3 out of year 5, they've already gone through their interest reserves. They've already gone through their contingencies because rates were at 3.5, now they're at 8. Okay, so these guys are sitting here going like, look, I've got a good asset, and we know this is going to be short term. I need some rescue capital, and that's where preferred equity comes in. So preferred equity comes in right behind the senior debt, and it's what's called preferred, and the common equity is behind it. So you'll get the capital stack looking something like this, maybe a $40 million senior debt, a $6 million preferred equity, and then maybe a $16 to $20 million common equity behind that. So it comes in and it avoids capital calls to all the investors. They come in and they actually provide that rescue capital to get through the next year or two. And most of these are short term, 1.5 to 3 years. You're not looking at pref equity going, way out like common equity, but the pref equity gets a fixed return, a contracted return, typically somewhere in that 10 to 12%, typically paid quarterly. And then when the deal transacts, means there's either a refi or there's a sale or whatever it may happen. The pref equity is coterminous with the senior loan, so that's when you go out too. So when the new construction loan goes away or whatever loan it is right now, that's when the pref equity comes out too. So it's rescue capital. It's a great way for investors to still be in a real estate market with low risk because you have all that common equity behind you because you get paid first and you get paid completely before the common equity gets paid. So if you're looking for short-term investments, still like the real estate space, cash flow, it's really turned into be a really good option for our investors. And we have a lot of developers calling us and saying, hey, will you please look at our deal?
Is it mostly new developments that you're looking to place pref equity in, or?
Yeah, for us, because that's our wheelhouse. That's what we've been doing for the last decade with multifamily. And here's something else that's real important for us. We underwrite each one of the deals that we're doing on pref equity as if we were going to buy it. Okay. And the thing that could happen is if you think about it, and we're getting a front row seat to the asset, the deal. We're seeing how the property management's going, whether it's at the end of construction, lease ups, rents, all of that. So we're in the management group, and we are getting to see the asset perform. And what we think will happen is that maybe one or two of these that we do per year, we'll probably do 5 or 6 pref equity deals a year. But if we look at this, we're saying, there's one or two that we may want to acquire. And we're getting paid to sit there. And I told somebody the other day, I said, we're kind of like the Greeks and the Trojan horse into Troy, but we're bringing an olive branch. We're not coming in there to take over your city, but we're coming in and saying, okay, here's the rescue capital. We're inside. We got a front row seat, and we very possibly could pick up an asset that could be very discounted.
Yeah, that's a great way to look at it. I've always thought that way about uh, um, receiverships, but however, there's a conflict of interest, right? Like when you're set up as a receiver, like obviously you could take over assets, you can kind of get a first row seat of that deal.
Yeah.
But I do believe there's a great deal of conflict of interest there as well as it relates to the opportunity to actually buy that asset down the road, right? It's got to go through a certain protocol, but you're in a different scenario, right? And that's interesting. I love that. I love every bit of that. So talk to me about the when you guys are vetting sponsors, not just the deal itself, but vetting the sponsors. What are you looking for to determine? You like the deal, you like everything about the deal itself, but what would be a pass or go as it relates to a sponsor to determine whether or not you'd actually be looking to put pref equity into it?
Yeah. So, I mean, and that's a great question. I'll give you an example right now. We work today with only 3 primaries and maybe a fourth one, but it's people that we have a long relationship with. Now, how did we vet them in the beginning? We completely looked at their track record. We talked to their lenders, their other investors that they've had, and we weren't, we did early on work with some guys that were small shops. We ended up doing more legwork, making sure that everything went well. But I wouldn't recommend that. We don't do that anymore. So the guys that we have now, we have enough experience and enough tenure that it's really the track record, and we know how to structure the deals right, where we're, major decision rights, and certain things can't be done and certain things can be done. Because when we're bringing in that amount of capital, and most of the times we bring in anywhere from between 4 and 20 million per deal. Pref equity would be more like 4 million, and a common equity would be more like 20 million. We're gonna have a big say in that, and we're gonna do a lot of underwriting, and we go through a pretty extensive legal process too.
Sure.
And it's you're gonna I don't know if you remember this, but you can pay me now or pay me later. It was a commercial way back in the day. So we like to pay me now. And we've always find it's cheaper to pay me now and do your background checks on the front end.
Yep. No, I love it. I love it. Okay. Well, no, all great stuff there. Great insights. And so again, circling back to the SWOT analysis of the multifamily space, would love to maybe talk about weaknesses now. And again, I'll give my quick opinion or perspective, and then I would love your thoughts as well. So, weaknesses, obviously the debt markets, just weaknesses. It's a challenge, and I think everyone's well aware of it. So we don't need to even go down that rabbit hole too far. Along with debt markets, the spreads are just not nearly as attractive as what they were years past. And then, even lender liquidity, right? Like there's just, I think there's a fairly significant risk of a number of banks going out here over the coming years, and banks are already pulling back, and just lending's become quite restrictive. Even if they are still lending, it's become quite restrictive. And so I think those are some of the weaknesses. That doesn't just apply to multifamily. That applies to pretty much any commercial real estate asset at this point in time. But, multifamily, I feel like it's in the crosshairs right now just because it's gotten so much attention over the last decade. It's just, it's been one of the darling childs of the last decade or two. And so with that, would love your perspective. Kind of what are your insights as to where you see the weaknesses and where do they lie?
Well, I'll tell you what we're looking at. We don't think this is going to be a 2008 and 9 where it's just a collapse.
Right.
Okay. In the multifamily.
I agree with that.
Yeah. So, back then it was bedlam. I mean, it was chaos. The lenders just shut down. I think some of the regional banks that are heavy into real estate, if you've got a banking relationship, a regional bank, I think that you could position yourself to pick up an asset or two over the next few years because there's so many billions of dollars coming due or maturing between now and 2029. I mean, billions. And so I think some of the regional banks are going to struggle. We're talking to a few right now that they're not ready to, I guess, admit it, but we can see it coming. I think for investors, guys that I talk to on a daily basis, if you're looking at, interest rates, to change the dynamics of the market in the next 12 to 18 months, it's going to move the needle that much, maybe. Okay. Because the valuations and the leverage is going to drive most of that, the decisions. So the interest rates, until you get maybe through 150 to 200 basis points, it's just not going to matter on that. I think the other thing that we're really paying attention to is loan. How many, like in our Texas market, how many mid-level developers have projects that are ongoing right now? Do they have one or two? Do they have 10 or 15? Because we know some guys that have in the high teens that they've got this problem for several projects. And would they be willing to parse those projects or exit those projects sometime next year? So we're really going to pay attention to that. We think that I don't think there's going to be a lot of, and I tell this to a lot of people, that we're not going to see a lot of distress here. We're going to see discount, and we're going to see some good discount, but we're not going to see, I mean, we're not a distressed market. We're just going to be a discounted market. So, but other than that, we're planning, I don't think this year, maybe towards the tail end of it, that we'll really start seeing some really good opportunities to acquire. But I think 25, I think that's where the people with dry powder, or what we're doing is we're starting to build a platform for discounted assets so that when the time is right, that we'll be able to go in and actually make some acquisitions. But that's also why we did the pref equity, because we're already in there now. Yeah. So we've already got a
front row seat.
Yeah, we're sitting at the table. So and that's my whole thing. I tell my guys, I go, guys, we've got to get visibility into these things. And there's no better way to do it than get paid to do it. So, and that's why I said at the beginning, each one of these that we're underwriting as if we were going to own it. So,
so when you say you're building out that platform, are you referring to the pref equity program that you guys are running
correct.
Right now? Okay.
Correct. Okay. Yeah. We spent about the last 6 months, getting all the legal stuff done, working with certain developers, making sure we could have a pipeline. So we have 2 that we're launching, maybe 1 today. We may end up doing it today, and 1 next week, and then 1 probably about 4 or 5 weeks. And then we've got 3 more that we're evaluating right now. So we didn't want to do it one and done. We had to build, we had to make sure we had product, we had opportunities, because we didn't want to just, flip the switch for one deal and then flip back.
You mentioned that North Austin is definitely oversupplied, whereas South Austin not so much. And so, are you guys avoiding North Austin at this point in time, or what's your stance here?
Yeah. So I would, you're going to pick up, I think, a deal in North Austin before you're going to pick up one in South Austin. Okay. So we're not avoiding it for acquisition. We would be avoiding it for development. Yeah. So we would not, we think that in 25, there's going to be some, class A product that is going to be able to get picked up or get JV'd, and we'll be a big part of that.
What do you think realistically, your crystal ball, when you say obviously not distressed, but discounted, what do you anticipate those discounts looking like from, I guess, and what's that compared to? Is it, compared to peak pricing? Is it compared to pricing today? Just curious.
Yeah. Well, the easiest metric we use on that is just replacement cost. So if you give you a good example, when we were looking at it aggressively, it cost $220 to build, $220,000 a door to build, and we almost got it for $196. So to me, we got a 12% discount on that. I think those discounts are going to be more like 12 to 15, maybe being the target going into 2025.
Is that when it's cost to build? Is that what it cost to what it cost to build a couple of years ago during some of the supply chain crisis, or is that what it would cost to build today? How do you guys
Today.
look at that?
Yeah,
Okay, I
today.
got you.
So like, if it was, well, that one specifically, we had pretty good numbers on the construction. It was brand new. So
Hmm.
we kind of knew what the numbers were, but that would be a today cost. Yeah. So if we were going to try to replicate that deal, it would have cost us 220. We were about to buy it for 196. It had just CO'd, brand new building.
Hmm.
So,
Okay.
so we're saving, 20,000 a door. That's a pretty
Yeah,
good
that's
day.
great. So I think, again, I think we rolled into the opportunities there. So the opportunities would be obviously buying things at a discounted price, which is there any other opportunities outside of that that you foresee coming down the pike?
Well, we stay
As it relates to kind of the fallout of what we're going through right now.
we stay in our lanes with multifamily,
Hmm.
and I think you and I talked about this. We do a little bit of triple net,
Hmm.
but it's really me and a couple of other people, and I understand it. But as a business, we really stay just in our fairway of multifamily.
Got it.
Uh, and when we picked up the pref equity, component, now we're about to. You may be the first person I'm going to tell this to, so don't tell anybody else. All right. So
As 100,000 people
yeah,
download this
yeah,
interview
yeah.
this week, but
But we started, yeah, because we're building brand new product or funding brand new product. I sat back with my partner and we kind of looked, and I said, "My God, this is an 8,000 square foot clubhouse. This thing's gorgeous. It's huge. It's all brand new. All this." And I noticed all of our clubhouses, for the most part, that were in the second. We're primarily in the secondary market, so you've got a little more
Mhm.
land than urban space. I started noticing that, man, all of our clubhouses are big, beautiful, nice, sunk cost. Nobody uses them. They use the gym and the pool, and they get the wow factor when they walk in. But once they kind of get there after a month or two, they just sit there. And people try to have parties and games and beer night or wine night or whatever they do, but um, my partner was really into the co-work. And so you take a look at where's a value add you can help somebody today. So we're rolling out the first official co-working space
Hmm.
inside of an apartment that has no other co-working around it, and we're launching that in just about 60 days from now.
That's a good
And
idea.
when I say co-work, I'm not talking about just a couple of offices over here on the
Hmm.
side. I'm not talking about, just a couple of meeting rooms. I mean, this is full on podcast room, Zoom room,
Yeah.
Irish bar, library area, and a lot of it was driven not only by the revenue, but we started doing some research on mental health and social anxiety and human connection, and people were at that age group, the rental age group from 21 to 35. What the workforce has done is it's put people in their apartments,
Yeah.
and they're isolated hour after hour, day after day, and you bring them into a social environment. And we were looking like, hey, we're adding value to their lifestyle, and we're adding value to the development. And so we're gonna push that pretty hard. And actually, you're the first person I've talked to. We've been working on it a year and a
Oh,
half. So
that's great. I love that idea. That's a beautiful concept. Just curious. So if your average clubhouse is 8,000 square feet, like what proportionate share are you guys converting to co-working? Is it
yeah,
75%? Is it more or less?
well, shoot me if I ever build another 8,000 square foot clubhouse. All
Well,
right.
isn't everything's bigger in Texas, right? But no, I mean, but
Start
there
there.
it isn't. I mean, again, I just this is just it's my own opinion. And I don't know if there's any validity behind it, but like I'm under the impression that most amenity packages and these new built over the last, call it, decade, Class A apartment complexes. You have the big clubhouses, the fancy pools, the gyms, and well, I don't know, you name the other amenities, right? Um, most of it's for marketing purposes, right?
Yeah,
It's more the wow factor. Like I feel like I'm getting a lot of value, although I'm not even really going to. I think I'm going to use the value, but I probably won't. It's kind of like
yeah,
your typical gym membership, right? Like
yeah.
everyone signs up with the best intentions ever, and then they just kind of let that payment roll and roll and roll. It just becomes part of their budget, but they never actually even use the gym. So they're
Yeah,
kind
they
of
think,
paying for it in the apartment rent, but they're not really using all the additional amenities. But it did attract them in the first place.
yeah. Well, what we're doing is let's just say whatever the size is, about 20% we're setting aside for common area for all tenants.
Okay.
Okay. Leasing office, some private rooms, but the other 70 to 80%, we're actually working on making that a revenue model, like a pay per
Mhm.
use, a monthly fee, an amenity fee, all that. Now, is it money that is, huge numbers? No, but we've already got a sunk cost. We don't have to
Yeah.
pay, we don't have to build a building. We don't have to do
That's
anything.
beautiful. I love it. And that I feel like that's a true amenity that will actually, even though it's an additional cost and above, that's a real amenity. Number one, it's unique. It doesn't really exist. Everyone knows what co-working is, especially that demographic that you're serving. I mean, they're well aware. Someone in their friend network group, probably more than one, probably actually operates out of a co-working space somewhere within
Oh
their
yeah.
city, right?
Yeah.
Like it's a pretty common concept. Now, I've got a funny story about co-working. I accidentally ran across it about 14 years ago when I was in Denver, and nothing existed in Florida at that point in time. And I owned a 4,000 square foot building. I didn't use much of it at all. And I was like, man, this is a brilliant concept. You know what? I'm gonna build it out and just see what happens. And no one understood it here. It was pretty. I gave it like a year and a half, but no one understood the concept. Fast forward, I just I leased out the rest of the space, kept the space I needed, and then ultimately, about 5 years after the fact, is when it really got legs here in the Tampa Bay and just really Central Florida area. But I love the concept. It's a beautiful thing. I've worked out in many co-working spaces over time when I travel, or if I need like a
Yeah.
real dedicated space to work out of, and the hotel's just not cutting it. Co-working is the way to go. So I think it's a brilliant concept that you have there, and
Well,
what
and
a
I
beautiful
think,
way to add a
yeah. And I
profitable amenity that's truly going to be used. It's going to add real value to their lives.
It is, and we've got a lot of data, and a lot of numbers on it. But I think the other thing that I really saw on this was not only is it just straight up, revenue, but what it does socially. And then
Mhm.
from a competitive standpoint, if you've got five complexes around you that don't have anything like this, and you go over to see your buddy who's got this beautiful co-work space that's designed for digital nomads with all the technology and I mean everything that's in there, you're probably going to consider moving over to that apartment
That's
complex
right.
when your lease runs out. So there's a lot, there's a bunch of legs to this in variable directions. But
I love it.
we're launching our first one, and we've branded it, and we think it's going to be really good. We're hopeful, very hopeful.
Well, that's exciting. No, I love the concept. Brilliant idea. Would love to. I'll follow up and see how that goes for you. May bring you back one of the year or something like that, and just check in and see how that concept's going because I think that's absolutely amazing. So,
Yeah, I
um,
think we're our late April, early May, but by May, June, I'll have a really good idea and pictures and videos and blah blah blah. We'll have
okay.
all kind of good stuff.
Is it going to have its own? Are you going to create your own brand out of it? Is the co-working aspect of your apartment complex is going to have its own identity?
Exactly. We've already started
Okay.
that so that
Okay.
we'll see this brand and this logo, and it just like branding for any type of business. If you see that brand and logo, you know exactly what's in there. So
Hmm.
yeah, but that's the plan. And
No, that's beautiful.
we're not doing it just for ours. The whole thing is we're doing it on our deal,
Hmm.
on our complex, but we could easily come in and retrofit a building, and not and do the exact same thing. And it's not that expensive. In fact, you made the comment about it. You may pay a little bit more. Our FF&E budget for that clubhouse, that furniture, fixtures, and equipment, and when we converted it over to the co-working equipment and furniture, ended up being about $50,000 more was it. So,
Wow.
if you look, yeah, we took that budget and just took that line item, and we were able to get most, I mean, other than the 50 grand, it matched. So just higher, better use, highest and best use of that space.
Should be a pretty quick payback period then.
Uh, it's,
And which typically would have been, right?
So
Yeah. Well, that's fantastic. I appreciate you sharing that. That's a great idea. Again, would love to kind of follow that concept and that trend, and maybe just have you back on another time and check in and see how things are going. So, but with that, we're rounding out on time here, Dan. Really appreciate you coming on the show. It's been a fun conversation. And for those that want to follow along with your journey, learn a little bit more about what you guys have going on, or just check out some opportunities that you have available for investors. I mean, what's the best
yeah,
ways to track you down?
yeah, Kevin, I appreciate it. You know who Carl Rove is? He
I
always
do.
he always puts a sign up here and he does these little things like this.
That's awesome. I love that.
Clubcapital.co/investing. Yeah, clubcapital.co/investing.
All
So
righty.
that's actually going to take you straight to the pref equity landing page. And there's a couple documents on there. There's a pref equity 101, then a little bit deeper dive into what pref equity is and how it works in the capital stack. But you can get to our website there and you can get to me there as well.
Fantastic. Well, Darin, it's been a pleasure having you on the show. I appreciate you coming on.
Hey, Kevin, thank you.
Alrighty, guys, that's how we all have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.